What happens when stock markets are oversold? Unlocking the secret to stock market success requires an understanding of the concept of oversold. In this video, we will show you why you must understand this concept, what it means, and what kind of return can you expect when the stock market is considered oversold. Stay tuned, and we'll answer all in this video. Before we start, we remind you that you find our best strategies on our webpage. We share tips and tricks for both trading and investing. First, to navigate the market's complexities, you must grasp the principle of mean reversion, the main principle to understand the term overbought. In statistical terms, this means that strong deviations from the trend will eventually revert to the mean and move in the opposite direction. So what exactly is oversold? It's when the market has experienced a weak period with falling prices, which could be days, weeks, or months. The exact duration is up to you, but it's crucial to have a clear definition. If you use a daily time frame in trading, for instance, a period of 5 days could be considered oversold depending on how much the stock market fell during that time. At Quantified Strategies, we like to rely on numbers to illustrate our points. Therefore, we will use the RSI indicator to prove our point by formulating a trading strategy to identify oversold conditions. Hopefully, with this knowledge, you can make better decisions and achieve improved returns in the market. Let's find out what happens when the stock market is oversold. We backtest. We make the following trading rules. 1. We buy S&P 500 at the close when the 3-day RSI is below 20. 2. We sell at the close after N days. This is a simple strategy, but we make it simple to prove our point. The relative strength indicator, RSI, is used because it goes from oversold to overbought conditions constantly, and it measures the velocity of those moves. When values are low, it indicates a depressed market. Our backtest is summarized in this table. The first column shows when we exit. Row 1 is exiting after 1 day, row after 2 days, and so on. Column 3 shows that the returns in from the second day and onward are higher than any random period, which is about 0.04% per day. However, as time goes on, the returns gravitate toward the long-term averages as expected. Let's make a backtest with the following trading rules. We buy at the close when the 3-day RSI is below 20, and we sell when the close is higher than yesterday's high. Let's look at the results. The equity growth shows a steady upward growth, and our equity grows from 100,000 to 1.3 million during the period. Not bad for such a simple strategy. Even better, the drawdowns are small as indicated in the lower pane. The annual return is 9.14%, even though we are invested just 16.8% of the time. Thus, the risk-adjusted return is 54%. We find risk-adjusted return by dividing 9.14 by 0.1681, which is time spent in the market. So, to conclude, our backtest shows that we can expect higher returns in the short term than any random day when we have an oversold condition. That's all for today. Thanks for tuning in, and we'll see you in the next one. And by the way, don't forget to subscribe and like so we can keep delivering free videos.